Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host, Jordan Rochester from the Global Markets Research Team. And in this episode of our Fireside, I'll be talking with both Craig Chan, our Global Head of FX Strategy, and Albert Leung, our Asia Rates Strategist, both on their thoughts for 2021 and the trades ahead. I'll be asking them, what do they expect for the dollar and CNH next year? What sorts of big outperformers they expect to see too? And the risks for both Asia FX and rates ahead as well. Now, first of all, Craig, for full disclosure, we're recording this on the morning of the 7th of December. So we still have Brexit, the ECB meeting, the EU Council, the Fed, and many other events to get out the way. So because of that, I want to talk with you about the higher conviction, longer term flow and macro trends that you think we're going to see in 2021 for FX. And that should remain the case no matter what happens over the next couple of days. So think of this as the medium-term FX view, folks, at home going into 2021. So with all of that said, let's talk about the broad dollar. One thing that has changed is we've had a change of administration in the US with Joe Biden, president-elect, on his way to the White House in January. So with him likely to be sat in the Oval Office next year, Craig, what does this mean for the broad dollar in your view?
Yeah, thanks, Jordan. So I think there's probably a few angles we need to look at this. I guess the broad conclusion is that we should have a softer dollar coming through. But in terms of the few aspects around it, the softer dollar view because of Biden, I think the first one is just the result itself. The fact that we're likely to have not just Biden, but a potential Republican Senate as well. Now, I know there's risks around this on the 5th of January, but it does seem like the scenario will be Biden plus Republican Senate, which should actually mean less stimulus. And I think that is very important because it reduces the US outperformance story. I think that would be the case for 2021, which then probably raises the risk that you might have to see more come through from the Fed. So even if we don't get something from the Fed this month, the risks around the lack of stimulus or the difficulty in getting through fiscal stimulus may mean the Fed will have to do more ahead. And that could be what the market will continue to expect. Now, the other angle is around, I guess, more kind of global perspective. So, the fact that we have a Biden-led administration, I'm looking at the administration itself, it does look like we're going to be going into a scenario over the next 4 years where there's going to be less global politicking. Now, it's going to be very important, which I think will imply, generally speaking, less volatility for markets. So not like the when we had the previous the administration under Trump, where there's a lot of kind of direct policy actions that create a lot of volatility in markets. I think that's probably not going to be so much the case under the Biden leadership. Now, the other thing is, I think from the global side, probably the view around China, reduced kind of direct actions against China, I think that's kind of largely priced in. People expect that. But then I don't think people have really thought about the scenario about tariffs. Can you imagine if people started to talk about tariffs being removed tomorrow? I think this would be really good news. You'd see renminbi rally substantially. And of course, because of that, indirectly leading to the dollar weakening as well. So I guess overall, in terms of conviction around the softer dollar view that we've had throughout most of this year, I think it will remain intact going into 2021 as well.
I mean, that's important. I hadn't considered that myself on the tariff point. So usually when we talk about risks, we tend to talk about the negatives, but it seems like there's also a balance there with a positive tail risk to the right-hand side. Well, let's bring it on to CNH. You mentioned the tariffs there, Craig. It's already moved a lot this year, both the dollar and CNH. But the point I make with clients is that COVID-19 has already made many economic records. Why can't it make records in FX too? And the question I have for you, Craig, is it more of the same in 2021, more CNH strength and dollar weakness ahead?
Yeah, 2020 so far has been a very good year for CNH. I think for 2021, we should see less volatility coming through from the global side for renminbi. Probably less volatility, not just around direct conflict around China, but 2020 was a substantially volatile year because of the outbreak of COVID. And hence, given that we are in the process of at least pushing forward with potentially vaccination soon, I think the volatility from some of the global factors will definitely drop off in terms of impact on renminbi. So for first half of next year, I'll be looking at dollar China coming off to around 630. Quite a reasonable amount of appreciation of renminbi just in the first half. And probably by the end of the year, we're looking around the 620 kind of levels. Now, I just mentioned that there is this global support coming through, but I think from the local side, there's also massive supportive factors. So we're still seeing, substantial trade surpluses coming through, partly because of the COVID shock that's come through. We've had a lot of, if you want to say, exports of pandemic-related goods. We've had a lot of exports of goods which are related to working from home as well. So we have this really large trade surplus, current account surplus, with the fact that there's a lack of outflows from tourism. And we are starting to see now, very recently, inflows into the Asia region and even into China pick up quite substantially as well. So we have this, I would say, a really good sweet spot for renminbi appreciation to come through. And I do think that our targets of 630 in the first half will be certainly met. And in fact, I can imagine that once we get to these kind of levels, expectations of the market for even greater appreciation probably will build quite fast.
The trend is your friend, Craig, until it ends. But I like the sound of that. Let's say 630 in dollar CNH. Is that the outperformer? Is China the outperformer next year in the Asian FX currency space? Or is there other country that stands out to you?
Yeah, that's a very good point. I do think that, China will perform exceptionally well next year. But I do also believe that there will be other currencies in the region that will perform very well. For example, Korean won. I do think that that's another currency that will stand to benefit substantially from the global backdrop, from the renminbi appreciation to come through. I also think that there is a local story around Korea. So it's not just about the global backdrop being, very favorable for Asia FX, foreign capital inflows. But I do think that Korea is seeing something somewhat similar to China. This pickup in global electronics demand that's coming through, again, a part function of the work from home. But also going to next year, we also have other factors, things like 5G. We have obviously the new iPhones continue to be produced as well. So there is something that's beyond the kind of work from home that everyone talks about, demand for electronics. There's a very positive story around exports, the trade surplus, and also the current account surplus as well. So again, this is one currency in the region, along with China, where I think there is a kind of sweet spot being reached. You had the shock, current account surpluses are large. The turnaround in these surpluses will be relatively slow, but now because everyone's talking about the recovery that's coming through, and you've had all the positivity around COVID, vaccines, for example, portfolio flows are definitely going to pick up. So again, this is another currency that I see performing pretty well. And I believe that, in the next few months, we could actually move around 3%. So we have a forecast of 1050 in Q1 of 2021.
What about the Asia carry trade, Craig? So Korea's there is one of the outperformers that you're looking for. What about the higher beta sort of currencies too?
Yeah, I think definitely there's going to be a search for yield. I do think that is going to be, again, one of the other themes going into 2021, given that we have this, extremely kind of loose global financial conditions, the potential for, if you want to say more kind of positivity around risk, whether it's about US stimulus coming through, even though it's marginal, whether it's about the COVID vaccine, perhaps the distribution to Asia is going to be faster than people are expecting as well. But there is a lot of positivity that's building. And I would say that you probably have to differentiate a little bit. Probably the one place that I think will perform better is actually India. I do think that one negative factor against the rupee has been RBI's consistent dollar buying intervention. But I think that's about to stop. I think they have built more than ample reserves. They have a domestic liquidity problem. There's excess liquidity, and so intervening won't help them. I think there's a recognition that they have a liquidity problem as well. And there has been issues around discussed within the RBI about the costs of intervention. So I do think that India is moving into a position where if we do see more evidence, and we started to see a little bit of evidence, not very clear, but we're starting to see some evidence of them backing off. If they can back off more, I do think that we could be in place for a pretty strong appreciation of the currency there. So the search for yield will probably be in India. I don't think Indonesia benefits as much. Indonesia will benefit because it's a high yielder, but the problem is about Bank Indonesia credibility. It's a big issue. People are concerned about how Bank Indonesia's mandate around FX stability could actually change at any point in time. It's going through the legislative process for a change in what they should be looking at in terms of the target. So we could run into big problems in Indonesia just overnight if you have this bill actually going through in terms of Bank Indonesia Act changing. So I think there is probably a better story in India versus Indonesia in the high-yielding space in Asia.
Well, Craig, we've spoken about a few of the risks there. Indonesia's clearly on your radar. What other risks are there next year for the main view about the dollar weakness, CNH strength, and as you mentioned, Korea and India outperformance? I mean, I've been looking around. There's so many we can talk about. We've still got Brexit this week, but I'm going to ignore that for now. I'm thinking more about what could happen in 2021. Potential slowdown in China is one of the risks that people talk about in the second half of next year, not the first. There's been some recent high-profile state-owned enterprises defaults that have been taking place. Is that the risk that you're watching, or is there something else completely?
For sure, that remains a risk. I think particularly as we go into next year and probably the latter half of next year as well, if we are going to have this recovery in global economies that we forecast, then the risk will be that the market will start thinking about the expectation of future hikes. Term premium might rise around the world. And I think that's a bit of a risk for markets in that, if you look at Asia in particular, the private non-financial sector debt is actually extremely high. So China is one of the highest as percent of GDP. Like the last data point that I've looked at was at the start of this year, and it was around 216% of GDP. So pretty worrying numbers. The fact that we haven't even really moved into that scenario yet in terms of global rates potentially starting to demand if you want to say higher term premium, it's worrying that you actually might get even more risks appearing as that process happens, whether that's the second half of next year. So I do think that is one quite substantial risk. It's not just China. Look across the rest of Northeast Asia, the level of private sector non-financial debt is notably high, well over 100%. It's extremely high. So I think that's a bit of concern to me as we kind of move into the scenario of rising term premium, whether that's the second half of next year. There's other near-term risk as well. So, as you mentioned several times, Jordan, around Brexit, I mean, that could cause a kind of short-term negative reaction in positioning in Asia FX. I think it would be short-term. I think that people will start focusing back on the kind of more medium-term positive developments probably soon afterwards. But it could be quite a bit of a negative reaction to that. There's other things as well. If we think about, there's still time in office for Trump from now till 20th of January for him to potentially implement, negative policies, whether that's targeting China. It's very possible he could do that. So that's something that's still a bit worrying until, the Biden administration actually comes in itself. And as I mentioned before, just watch the 5th of January, where, you have that Georgia Senate runoff elections. I think if you do see the scenario of the 2 seats being won by the Democrats, I think actually it would be a surprise to the market. And I think there'd have to be some repricing of some of the policies that Biden wants to push through, whether that's around higher taxes. So there's quite a few risks out there, and I think these are not kind of risks that we think will change the trends of the market, but nonetheless, it's just things you need to watch out for because it could delay our view around the softer dollar, Asia FX appreciating as well. Now, Jordan, maybe I think it's quite good timing for me to kind of turn and ask some questions to yourself, because clearly the view is around the softer dollar. And we have had, one of the biggest drivers of this broad softness of the dollar being euro dollar. Euro dollar has moved 12%, and more since, the kind of 108 levels earlier this year. I guess the question is, can the Euro area and the ECB really handle that? I mean, it feels a bit of a consensus to be a long euro here. Just, I guess, how confident are you around this view?
Well, Craig, pretty confident is the answer to that question. I have about 30 different flow charts, medium term to long term, that tell you reasons why the dollar should weaken and the euro should become stronger. I've only got about 2 charts, and that's me really trying, that I find tell me that there's risks that euro might weaken here. And so it's not just all one way. There are definitely risks, and maybe measuring it on the number of charts is not the right way. Sometimes one chart is worth 1,000 words. Sometimes no chart's worth 2. But I think, Craig, that if I'm asked about the broader trend, it's going to remain euro higher, sort of 125 next year to 128 is the sort of range I'd expect us to be finishing the year in, with the idea of 130 or higher requiring a lot of dollar negative factors to increase in velocity, which will require a reassessment halfway through the year, I would imagine. Now, part of the reason has absolutely nothing to do with the upcoming ECB meeting. I think the likelihood of a rate cut from the ECB, maybe they do a rate cut, 10 basis points, let's say, that is a risk, of course, to euro dollar. Maybe they talk about the currency and talk it down. That is also a risk for mood and sentiment of the markets. But it doesn't stop the overall reasons why euro is going higher in the first place, which is hopefully with the vaccine rollout, Craig, next year. The big reopening trade is all those countries that suffered a lot this year, thanks to the shutdowns, they turn back online. And so if you look at it, who are they? They're countries that are highly exposed to travel, tourism, services, hospitality and leisure. That's Italy, that's Spain, that's France, that's even the UK. And those trades have yet to play out fully, given vaccines haven't yet been rolled out. The other factor is the flows, which it's more consistent to talk about than the macro, which can have these wobbles here and there. Let's first talk about the 2 charts that I think that are the risks. One is on credit risks, of course, given COVID-19 continues to escalate the number of cases in Europe. We've seen some sign that lockdowns work, but we're only just into the first month of winter. We've still got January and February to go, so it's going to be a rough winter for Europe. Despite vaccines on the way, we could expect more lockdowns until probably March or so. The other, Craig, is on positioning. Hedge funds and real money positioning in Eurodollar. The total number is quite high. We've got large amounts of long euro consensus positioning. That's always the risk to FX. Whenever something becomes consensus, it always tends to go the other way. Not in this case, though. You've got to look under the hood and look at the plumbing of this. It's actually mostly real money investors who hold that euro dollar position. They're not really that price sensitive. This is more of a long-term trend. It's been building for a while within their space. Hedge funds are completely flat euro. They haven't got any of it on. We've seen a reduction in their euro dollar shorts over the past few weeks, but they're not net long euro dollar, which means there's room for this move to go. And just bringing it to the more medium to longer term sticky flows that I think will matter the most. First of all, that back to work, back to normal vaccine trade. We're seeing it play out in the ETF inflows, foreign investors buying German equities in November, and they had been buying over the summer as well. Then there's the impact of the Fed cuts. So we had those Fed cuts earlier this year, which has changed the sort of state of play for FX hedging in Europe, which according to our estimates, looking at the sort of proxies we follow, FX hedging ratios in Europe haven't yet increased, but they should do going forward in the months to come, given the cost of hedging has collapsed for them, which should weigh on the dollar. And then if I talk about the balance of payments, the sort of real longer term drivers, the double deficits in the US are extremely wide. They're also extremely wide in Europe and the UK. The big difference is that in the UK and Europe, the ECB and the Bank of England are buying up most of that extra government issuance. Where in the US, it's not the case. The Fed is actually not buying anywhere near as much as the extra issuance from the US Congress. And so what does that mean? We have a world with excess dollars, Craig. So the likes of 125 to 128, that's the sort of view from us in Eurodollar next year. And we've talked about a few of the risks as well today. If there is an ECB rate cut, that is clearly a near-term risk. If there's a hard Brexit, that's clearly a near-term risk. But I don't think that's going to change the outlook for our broader view next year.
Excellent. Thank you.
Thank you, Craig. Well, let's talk more now about Asia rates. We talked about Asia FX. We talked about the view on the euro and the dollar next year. It's why I'm going to bring in Albert Leung here, our Asia Rates Strategist. Albert, how are you?
Yeah, not too bad. Thank you very much.
Let's talk about the potential next year for this back to normal trade, or as some people have called it, the everything rally. And that's on the back of this vaccine rollout. So many different sectors will open. Many countries will be able to reopen their tourism, travel, and leisure sectors. So what's the best way to play for this in Asia rates, and is it already in the price?
Okay, Jordan, I think you're absolutely right. So I think a positive global risk backdrop, the weak US dollar, and the central banks in Asia to remain accommodative should all be supportive of bond inflows to Asia. As to which market is best to position for this, I would highlight India and Thailand as our two topics. So for India, we expect the government bond yields to move lower. I think apart from being a high yielder, I think that the Reserve Bank of India is likely to continue to support the bond market via OMO in 2021, as they have done extensively this year. And we also expect the commercial banks to step up bond purchase, especially if credit growth remains weak, given that they do have abundant liquidity. And the second market, Thailand. So we are actually very positive, but we're more positive than the market. And we expect the swap curve for both the short end and the long end to actually all come lower. There are a few key reasons for that. The first, we expect the macro outlook to be very challenging in Thailand from a combination of COVID-19 and also ongoing political concerns. We also expect the Bank of Thailand to keep liquidity flush, partly due to the concern about Thai baht strength. And the third point, which I think is actually most important of all, is our economics team have an hour of consensus 50 basis point cut forecast for the Bank of Thailand for this year, next year. So all the way down to 0%. And I think that this is the market is not close to fully pricing in that scenario.
Well, a lot of the Asia rates complex, Albert, also relies on the global prevailing trend in rates. So whatever US treasuries are doing, whatever EGBs are doing. So do you have any strong view on the global rates curve here? So is next year going to be like we've seen already, sort of steepen a trade? Is that how to play it as well?
Yeah, Jordan. So I think obviously the curve is also going to be something that the rates market focus on a lot for next year. So before we actually go into discussing the curve, I would like to highlight even though we are positive on Asia rates overall next year, I would still advise some differentiation because I think there's a second theme that could get a momentum for 2021, which is the reflation and the cyclical recovery theme. So I think the rates market that are more linked to the growth and inflation outlook, which is China, Korea, Taiwan, which happens to be Northeast Asia markets. I think I can see the rates curve steepening from here. So in particular, I think China and Korea are the markets where we can see steepening and potentially in Korea's case, even higher rates, probably or in the long end. I think the two markets have some similarities, China and Korea. So besides being more sensitive to the inflation outlook than flow, which I mentioned earlier, the bond supply in both markets will be quite high next year. especially for Korea. And also the central banks, China, PBOC and BOK, are not expected to ease further, given that there's some concern over financial imbalance. But again, there will be some differentiation. Since in ASEAN markets, we are much more neutral on the curve. In fact, we can see the Singapore curve flattening for next year because the market is more linked to the front end of the US curve. And we expect the US curve up to the 5-year point to stay very, very stable, or may even go a little bit lower, even if the long end sells off next year.
Well, then let's zoom in on a particular country or two next year. I mean, with the everything rally, it tells you that you don't really need to differentiate between countries, but I think you do. You always have to figure out which ones are going to be the ones that outperform the rest. Who are they for you, Albert?
Yes. So now in terms of which market likely to be a surprise or outperformer or will do really well next year, so I would use our 10-year bond yield forecast for 2021, which is also in our Outlook publication, as reference. So based on that, the Thailand bond actually will deliver the highest return on the total return basis. So this is something I already mentioned earlier in the top trades. So I would just add, in addition to the weak growth outlook and the potential Bank of Thailand easing for next year, the bond issuance target may also be too optimistic for 2021. Given the ongoing political tension could actually lead to delayed fiscal spending. So I think this is quite a key point because even though a lot of countries have to battle the COVID-19, at least they can turn up the fiscal. And in Thailand's case, that may not even be an option if the fiscal is constrained. So overall, we do expect the 10-year Thailand government bonds, for instance, the yields to come down 30 or 40 basis point probably from the current level. So for the other high yielding markets, India and Indonesia, and to extend China, we also expect them to do well. But for those markets, the return will be from a mix of carry and potential price gain. Whereas for Thailand's case, we think that it's largely going to be from the actual yield decline.
Well, with all of that, thank you, Albert. That's a wrap.
Okay. Thank you very much, Jordan.
So those are the views from us, those are the trades from us, and that's the fireside with Craig and Albert. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one. And please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.